my goal, and I've realized this more over the years, ultimately you just want to become more aggressive and more certain in your trades and be right more than you're wrong and have less drawdowns. That's it. So that's what I'm working towards. And the way you do that is by tracking everything I just told you. It's not only the trades that you was wrong at, but trades that you've left that you could have made money on, that you could have adapted into your system. That's real discretion. That's true discretion. Real discretion isn't putting your finger in the air and just thinking you know what the market's going to do, because no one knows what the market's going to do. If you think you do, good luck.
All traders have periods of self-doubt where you think to yourself, well, I can't even really buy a winning trade. I've forgotten what winning is like. And you do begin to doubt yourself. But one of the things I do when that occurs is I have a template for the instruments I trade. And I'll put that template up over various bits and pieces. And I'll put the time frame out to 10, 15, 20 years. And I'll just scroll through and I go, well, it saw that breakout, it saw that one, it saw that one, it saw that one. And you begin to start to recover your sense of confidence that you can actually do it. One of the things about trading is it presents us with a number of paradoxes. In trading, you must be humble enough to admit that you make mistakes, you make errors, you get things wrong. But you've also got to be fantastically egotistical enough to think, screw that, I can do this. And so you're caught with a paradox. And you've always got to be working on this notion of that quiet confidence that you can actually do it. Look, to be honest, my observation over decades is it is not intellectual ability that stops people doing well. Never has been. Trading is very, very simple. If you can use a mobile phone, then you can trade. If you can reset the clock on your microwave, which is the hardest thing I have to do twice a year when daylight saving comes and goes, then you can trade. In terms of the fundamental practical aspects of it, anyone can spot an uptrend, anyone can spot a downtrend. It's having the sort of, I hate the expression emotional intelligence. I think it's a terribly wanker expression, but I can't think of a better one where you've just got to have that maturity about you to be able to control yourself, because it's not the technical and intellectual aspects of trading that trip people up, not by any stretch of the imagination. It's always their emotional response to what's occurring. That's what blows accounts up. It's playing double or nothing. It's chasing losses. It's letting things decay to zero without taking any action whatsoever. And it is those things which are all emotionally driven, they're all psychological aspects that determine whether you can or can't do this. It's not the system at all. The systems are just a crutch to get you to do something. Because by and large, anything that buys new highs and has risk control works. Now, if that's true, why can't everybody who follows these systems actually trade? And the reason is it comes back to the person who drives the damn system. If you can't control yourself, if you can't be disciplined, then you will struggle. You'll always struggle, no matter what system you have.
I look at it and I say, listen, we're all going to make mistakes, but it's all about improving upon those. I think the common mistake that people make is that they see something running up or running down. Let's take the running up scenario. And when it's running up, slowly emotion starts to build in them and they think, oh, well, if it's already up this much and it keeps going up every candle higher, let me jump on because it's going to continue up. And what I found is that by the time most people jump in, it's just about to go the other way. And the same thing on the sell side. When you get most panicked, that's where you actually start to see the bottom being in. So once the market flushes out the retail investor, that's where the bottom is in. So the biggest thing I would say to investors is learn how to read charts, because once you learn charts, it then takes the place of emotion. It's like, okay, well, is the chart at a level? No. Okay, well, I sit on the sidelines. I can just sit on my hands. Most investors want to overtrade. The less trades, I actually became more of a profitable trader when I traded less. And I know it's counterintuitive, but the less you take, the more kind of keen on the good setups you're going to take. And that means your win rate goes up, and ultimately you won't be fighting as many losers out there.
The industry has lied to us. Everybody starts being told, hey, start on the daily chart and you'll have better results there, right? But they also neglect to tell you you're going to have bigger losses. And so over time, you find your way working your way down to like a 1 minute chart where you can actually afford to lose, right? It's losing on the 1 minute chart is very, very different than losing on the daily chart. And here, if I'm in front of a 1 minute chart and I'm witnessing the loss taking place, I'm in control. I can stop this at any time. I don't have to watch it go to 36 pips. I don't have to watch it hit my stop loss. I'm in control. And even as the market is moving, I can change the environment by adding an extra trade or 2 extra trades. And now all of a sudden, I'm not only in control of 3 trades, but I'm in control of the average of 3 trades. And that's the line that you're moving. You're putting that line closer and closer to the current price. It becomes your break even. All right. So now you're controlling where your exit is. You're not letting the market tell you where your exit is. And so by trading like an insurance company, by pushing back against losses, right, and taking in tiny premiums all day long, you can profit at this. You need to manage the losses. It's okay to lose. It's part of the game. We're expected to lose, right? But we need to control how big those losses are. And if you find yourself revengeful, that's 3,000 years of evolution. You know, if somebody rips you off, you need revenge. And it's in your DNA. It's in your DNA. You're learning to lose. You're learning to become a professional loser. You're learning to become a monk. Right? So taking a 10 or 15 pip loss, you have to go back, reverse engineer that loss, figure out where you went wrong, and then tell yourself, hey, that's no big deal. That's 4 or 5 wins. And then just get back on the horse and create those 4 or 5 wins. Right? So it's not one big loss and then one big recovery. That just creates mayhem. We need to control the loss and then recover that loss slowly and one trade at a time. Stick to your program, stick to your process.
Now, I can give you a pretty good story as to why an upward sloping triangle works or a cup and handle pattern works, but basically that's pretty much a work of fiction. But that doesn't stop me recognizing an upward sloping triangle. It doesn't stop me knowing that there is about an 80% probability that if the breakout takes place, that it will reach its measured move target. Intellectually, it's satisfying to give myself a story as to why this happens. Oh, it's because there's an increasing bullish pressure on here and there's a resistance there on both sides. Yeah, but so what? That's not important. What's important is that once that breakout takes place, for whatever reason, there's an 80% probability it will hit its upside target. That's what I need to know. Stories, yeah, they're great for reading to my grandchildren, but they're not so useful in understanding what's happening in the market.
Whether you're in business or whether you're a trader or whatever it is, right? Write this down. When things are boring and monotonous, that means profit. That means sustainable profit. When things are exciting and exhilarating and very kind of emotional, that's when you're probably either making big sums that aren't sustainable, or it's just it's very volatile. You know, your gains and your losses are very volatile, and we all know that human beings can't handle volatility in their emotions plus or minus 10%, more than that. So you want to really keep your equity curve plus or minus 10% from your average growth. Otherwise, you are going to become excited. Now, that doesn't mean to say that you shouldn't enjoy trading, right? You should enjoy trading if you're doing it. And the way that you keep that spark there is just constantly learning how to optimize, how to build discretion, how to review and journal and see where you're leaving money on the table, and understand how in the future you can start generating more profit by slowly dialing in that discretion. And that to me, looking at the markets is enjoyable for me. And I would say if it's not enjoyable for you, you want to question whether or not trading is your thing anyway. I would say you don't really want to be excited by your trading. Excited? Every time I've been excited, there was a time in April the 3rd in 2020, I had my biggest trading session, and I got a bit excited then, and I had to actually stop trading the lower time frames, and I haven't actually traded them since. And that was because I recognized that I was excited and what damage that could have done to my performance, or maybe I could have given back all that money to the markets over the next couple of years. So I went just back to my swing trading strategies and my higher time frame stuff. So if you're excited, let that be a warning. Just don't get too cocky. Don't get too, because you'll develop fantasies about your trading, and you might start shooting from the hip.